Well, good afternoon. Thank you for joining us for our updated building products forecast. We have so much information to go through. As you probably perceive already, the industry is shifting just very rapidly, and really quite exciting times in building products. Before we jump into our content, just a few things to have on your radar. So, as always, we have data that's available. Building Product Pro is our new home builder data for building product companies. So for companies that are interested in that, it's a great resource just to have on your radar. I think the most granular local market intelligence around pipeline activity, size of home, and obviously we're capturing all sorts of new information around like what's in those homes too. So watch that, please. Another point is if you find the insights useful that we're going through today. Shameless plug for our building products outlook. This is our subscription published research around building products. Uh, all of our best stuff goes here. So forecast, really thoughtful, original work around what's happening between product categories and channel shifts, what's happening among the complex pro. We captured what was happening before we saw some of the big retailer moves. And I'll touch on that later on today. But if that's useful, if that's interesting to you, you definitely should have access to our research. It costs less than a person, a lot less, and we have so much information that we can scale across our clients that you should have it on your radar too. And then also a plug for our Zonda advisory team. So we have a whole broad experience team that touches all custom work that we're not able to do on a subscription basis, on a syndicated basis, but allows us to go really, really deep on individual categories. So you've seen some of those familiar faces at right here, Ali Wolf, Tim Sullivan. We've got a much larger team than that. But if you're interested in something specific for your category or for your company, let us know. And of course, we'd be happy to scope out what that would look like. And then we're thankful to be able to bring this presentation to you from Azenco, redefining outdoor living standards, beautiful pergolas, cabanas, carports. If you've ever seen any of their products, really well made, high quality products. And just a few slides here for our sponsor. Better design, better quality, better experience. Please check out their materials and their products. It's the type of thing you'd probably want in your own home. So with that being said, let's get into the discussion. What we're going to do is really just go through three things. We're going to give you an update of what's happening in the industry right now, 2024, as well as a sneak peek at our forecast for next year. There is so much that's new, even since the last time we talked, that you're going to want to make sure that you take careful notes. Reach out to us, please, if there's something that we touch on that we don't have time to go back to. Because of the amount of time that we have, we probably won't be able to spend a lot of time for Q&A, but we do want to address your questions. So please take the survey afterwards, ask any questions there, or reach out directly to any of our team or Matt or myself, and we'll be sure to take care of you. We're going to spend a little bit of time talking about the Complex Pro, which has gotten more attention recently. That's where Home Depot and Lowe's and now some new entrants are focusing some of their time. And then we also are going to preview some of the new learnings that are right ahead. The industry is moving pretty rapidly. So we think the concentration of profits perhaps could change between some of these brands. Matt's going to show you what that looks like. So let's start out with this. Do you realize what an unusual time it is in building products right now? So here's three headlines that all happened in the past 3 months. In fact, just within the last week, there's a big announcement from Brad Jacobs, obviously a new building product company entering the industry, 3.5 billion raised in capital. I think it's the largest capital raise in building products history. And obviously with the goal to expand much beyond that, we should be thinking about a large player entering the space upstream. Very exciting. And obviously right next to that, Home Depot's acquisition, which just closed for 18 billion plus of SRS. That's really a pro contractor play. These are massive deals that are happening all at the same time as the third headline. Cabinet sales continue year-over-year decline. Did you know that custom cabinets are down nearly 20%? 20%? So how is it possible that the industry is declining for certain segments pretty rapidly and we're seeing these huge checks being written? Well, it's because we're in a pretty unusual point in time. So to give you a sense of what we mean, here was a note that we sent in April to our research clients, updated forecast at that point that risks were culminating, we believed, in the first half of 2024, which is right where we're finishing right now with really large swings between DIY and pro demand. And we commented here that we see more risk in the mid-range remodels. So think of remodels that are below $25,000. A lot of those are going to go through big box retailers, but there's a whole broad basket of categories that get hit. I think double-digit declines happening right now among those categories. We're seeing that. Then also we have to think through pretty carefully about what's happening among higher for longer prospective interest rates. There was some belief we saw mortgage rates come down 100 basis points immediately after November, and then they crept back up, and now we're seeing a little bit of moderation there. What we know now, we've dug on this quite a bit, that the game changer is really thinking through the accrued home equity and what that does for mortgage payment shock and how dollars get deployed on either future moves or remodels or both. We did send our clients a number, what we think the ceiling is for maximum, how much the market can take for where mortgage rates could go before things really coughed. But that's a separate discussion. What we think we need to share with you today is that the story of 2024 is deferral, 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 much more so than pull forward. I'm going to show you why, which is increasingly looking similar to what we saw in the early 1980s, that deferral rebound path. But we've got this backdrop of far more home equity, which really changes the path and pace of growth. So that's the headlines. There's 4 other points, with all modesty, that we have to really digest, that we don't think we've faced quite the same way in prior cycles, but we are now. So here they are. We think the overall cyclicality of the industry could be shifting. So this is an important point. Think of some of the conversions that happened over the past few years, from wood to composite decking, shorter-lived windows to more longer-lived windows, LED light fixtures, LVT flooring instead of carpeting. All those things change the timing and the cadence and kind of the discretionary or non-discretionary nature of when remodeling spending happens, which means it cycles faster and harder when the dollars come to bear, and it does tend to soften a bit quicker because you can defer those projects. That's happening right now, much more so than it's happened in prior cycles. We also think we're seeing an adjustment in the attachment rate of remodels. So what I would think about what that means is sometimes a window and door project was just a window and door project, and that's all they would do. That still happens, but we think that we're seeing more clustering. So a window and door project is also a window and door and a patio and a kitchen, where a homeowner is doing much more to their home. And it really has to do with the fundamental disconnect with the type of home they're living in now versus how they're living in it and some of the limited alternatives that they have. Plus, the access to that equity helps a lot. That changes things. We also think that if you had built a regression, if you had built a model, that model is probably giving you a worse signal now than it was years ago. There's a degradation of some of the macro variables that are going in. I'll touch on this in a moment. And then pricing, which is always the hardest part of any forecast, is just getting worse. There's been more statistical swings in pricing in the past 4 years than there were in the prior 5 decades cumulatively. And we don't think it's done yet. So all those big investments that we talked about earlier, we think that future pricing is going to look quite a bit different than it does today. And those are going to be important to digest when that comes to bear. So briefly, here's our forecast that we published in April to clients. We'll be putting a new one out next week, next month, which will look different. But our general view, I think, will be similar in the sense that we expect about 12% growth on the new construction spending, which is building materials installed on new builds this year in 2024. And then we expect it to flatten out next year, maybe even decline. And that's all driven by multifamily and the timing of when those multifamily units dollarize into building product orders. So that's going to happen in the first half of next year, which is going to make that quite lumpy. At the same time, we're going to see a shift in the overall industry towards more home improvement spending, more residential repair and remodeling spending growth. So our forecast for this year is for -2%. And in mid-range projects will be far below that. I think near double-digit declines. 2025, we think the industry is going to grow almost 9% next year. And I tell you, this it's tough to call the quarter, but the trajectory, the pace of bounce, we have high conviction on that. In fact, we could be underestimating the pace of bounce in that case. For context, did you know that the current drawdown in home improvement spending, once we account for changes in prices, kind of peak to trough, looks a whole lot like what we saw the last time the Fed fought inflation in the late 1970s and early 80s. If we were using that signal as a comparable time period to today. Right now, we'd be about here, which would be about mid 1982, getting into 1983. And to give you context, by the time we got to 1984, 1985, the industry was going much, much faster. Think of over 25% growth on a sequential 3-year basis, year over year over year. We don't necessarily know the turning point, but we're seeing more and more evidence in the data that what we're seeing is postponed projects. And I'll show you why. Where are things soft right now? Well, as I mentioned before, we're seeing most of the softness concentrated among what we call middle income homeowners. So think 40th income percentile, the 60th income percentile, who did do significantly more projects than we think they normally should have, based on their balance sheet, particularly in like one-time items. So think barbecues and grills where you buy a unit, you don't need to buy a unit for some time. Major remodels, especially higher income, absolutely appear deferred, not pulled forward. And just to give you a sense of some of the softening that we're seeing on the one-time item side. So this is a comparison of Memorial Day pricing at Home Depot for a Traeger smoker. You notice the price there in the corner last year was $4.99. Here is the ad this year, $4.99. And if you were to actually show up in person at Home Depot over Memorial Day weekend, you would have found an even better sale in person. Now it's $110 off of that, $389. Bear in mind that cost generally for appliances and equipment like this were up about 1% year over year over the same period. So that's obviously a direct impact on profitability. There's some load-in issues going on there too. We're seeing that because it's a one-time item and a very focused in the demographic that's pulling back their spending right now. The other issue, and what I want to touch on here, I'm going to show you all the bad news first. And then I want to show you why we're so excited about what comes next, because we think the bad news is essentially bottoming right now where we're at, or at least over the next quarter or so. I want to flash back to 2020. Do you remember during COVID when we looked at some of these numbers that were facing the housing market, for instance, like the home ownership rate here, and we saw these huge swings, just monster increases, like 10 years worth of home ownership rate growth in a year. And we knew something was wrong because of COVID. Some of the same technical issues that are happening when that was being collected are infesting some of the other data that's historically used to predict housing and predict remodeling spending and home improvement spending. So for example, this issue here at Wright, that was a surge in the home ownership rate. It was really skewed by an issue of non-response bias from the census. And I don't want to bore you with that technicality, but this is what you need to see. So that surge, this jump in home ownership rate that was reported was associated with during COVID. It was very difficult for the census to get responses. You couldn't drive to anyone's houses and get responses for some of the other surveys too. This purple line was the issue at that point. And because of the adjustments that the census had to make at that time to account for that, it caused that big swing. Obviously, then we realized that was an issue, and we were able to kind of work through that. Here's where we are today. And just to give you a sense, this feeds into all sorts of data points that are used in predicting building products and predicting housing. Think of like wage growth, population growth, household formation. This is the household survey that's referenced by the BLS. It's even used by the Fed in estimating, what the overall health of the economy is and what their future plans will be for rate trajectory. We've been investigating this pretty thoroughly, and I was very pleased just with the cooperativeness of the census. Some really excellent economists and statisticians there. One of them shared this point that they found due to that issue that I just showed you, income statistics are skewed erroneously wrong upward by 2 to 3%, right? Which means that what you'd expect home improvement to do today has to be brought down because the numbers that you're feeding into your forecast are bad. There's other issues too. Today we published a piece to some of our research clients regarding some of the underlying supply-demand issues with housing. If you want that, I can send it to you. This is infecting all sorts of issues. So we're giving you bad news first. And here's one last point that's happening at the same time. which it has to do with the timing of this excess savings buildup. So if you've been tracking this, the San Francisco Fed does some really excellent calculations around excess consumer, pandemic era savings, which has been buffering the drawdown in kind of overall wage growth over the last few years. In February, we put this piece out to clients that said at the current burn rate, consumers would exhaust their excess pandemic era savings by the end of February. Now, obviously, we're in June right now. So we've completely exhausted the excess buffer. And it's not lost on us that, the line item that the Home Depot and Lowe's use to forecast the overall potential spending that they can go after, which is personal consumption growth, that the growth that we saw year over year in that 922 billion is almost to the letter the same number as the drawdown of cumulative excess savings over the same period. So another way of saying that, we had this excess padding that kind of insulated the overall home improvement market. We saw softness in home improvement, but it was buffered by the drawdown of this excess savings up until Q1, and now it's gone. So that's part of the reason we're seeing a softening in some of those, price point specific issues. So now let's move on to some of these other issues that you need to have on your radar that you might have not had before. Let's talk about the lock-in effect. So how I think through the lock-in effect is this way. There's an initial honeymoon, if we want to call it that, when you first move into a home, either a resale home or a new home, when you're putting new furniture in the home, when you're getting it your own and buying appliances. If it's a resale home, you're also doing some home improvement spending in that first 24 months. But there's certain types of remodels and projects that actually increase once you get outside that first 2-year honeymoon, because they're not the first list that are on the punch list of projects that you first do. So for example, siding is one of these categories, decking is another one, that people typically do these after people have been in their home more than 2 years. So what we did, and we sent this to clients a couple months ago, is we think about handicapping some of the individual product category differences due to this pull forward issue that's going on and due to the timing of what's happening with mobility. Here's how we think through that. So here's how much we'd handicap whatever your forecast is for 2024 home improvement spending. Here's how much we believe you should handicap each product category due to that middle income exposure and pull forward issue. It's not a ton, but it is significant for a few categories. Here's how much we would incrementally change on top of that, each of these product categories based on what's happening with the lock-in effect, meaning that there's certain categories that actually benefit from the lock-in effect when people can't move and they spend on their homes instead. There's other categories that get hurt. Siding, driveways, decking, pools, all benefit from the lock-in effect. We don't see the same lift to companies or categories, say like flooring. So that nets out with a really big difference, almost 9 full percentage points or more between some of the categories just due to those two issues. And those aren't the only two issues that the industry is facing. So why are we so positive on the long-term kind of pace of industry rebound ahead? What's going on? Well, let me show you a few pieces that you may have not seen before that we think are really important to think about growth. So let's first of all talk about festering discontent and a shift in homeowner psychology that appears to be happening that we think is going to drive a wave of future moves or remodels or both. Okay, so the New York Fed does a survey every February asking about how consumers feel about purchasing things and what their intentions are for moving and what they're planning on doing. And what we saw for about the past, call it 10 years, is there's been this slow drift towards younger households under 50 years old, expecting a lower and lower likelihood that they were going to move over the next 3 years. So from 2015 to call it, COVID era 2020, but even a few years before that, we basically saw this slow drift towards less moving expected, in part maybe because of an affordability squeeze that was happening slowly over that time. Then COVID hit, and then people reassessed how much they were planning on, living in their homes, where they wanted to live. Here's what we saw happen since then. So we call this a shift in housing discontent, meaning we still have seen this drift a little bit to the left as rates have increased, but the expectation. This is the y-axis, the percent that are planning on moving within, say, the next 5 years. It's hard to call the time when rates will come down, when it's affordable, but they're going to move when they can, has clearly shifted upwards versus the entire period of where we were from 2015 to 2020. And what's really interesting about that shift in 2022, that first jump up, that was collected before rates hiked, before we saw that payment shock towards homeowners. What we think happened was people got into homes that they purchased, immediately during that scramble post-COVID, and they really wasn't that good of a match. So we're calling this holding a beach ball underwater, meaning that these are festering future moves, future remodels, future new builds potentially, or a mix of the above that's going to happen in the future. That's a shift in consumer and homeowner psychology that wasn't there before. Here's another point. Maybe you've seen this, but maybe not. This isn't historically how the industry's talked about home improvement spending, but I think it's the right way to think about it. At its core, remodeling spending and home improvement spending is a function of homeowners who are occupying a certain amount of square footage of housing. And so what we have here is, if you controlled for prices and we graded remodeling just like you'd grade the builders, how much it costs to have pro labor per square foot, what materials are per square foot, you basically assess them like they were home builders. The long-term historic norm was for home improvement spending per square foot to be about $1.26 per year per square foot. That jumped up during the subprime boom. You can see that to about $1.50 to near $1.60. But then below that, it was actually a pretty stable number, about $1.26. Here was the jump from 2019, pre-pandemic, to 2021, the huge year. I don't know about you, but this number on a volume basis, we've controlled for cost here, doesn't look like as much pull forward as sometimes I hear discussed. We think what happened was basically homeowners did pretty much a slightly above normal amount of home improvement, but they did it at a time when it was very expensive to buy products. There were shortages. You couldn't get pro labor. And so when you do the overall like percentage of GDP calculation, it looks unusually large, but it doesn't mean there was that much pull forward volume versus what you might normally expect. Here's where we are today. Look at the 2023 and 2024 numbers. Almost as far below historic norms per square foot, which is the right way to look at it, we think, as we were above historic norms during the subprime boom. So our aggressive forecast to rebound in 2025 and 2026 doesn't look that aggressive to me when I look at it this way. In fact, it could be low, just based on how much we should be spending just to keep up with what's happening with home improvement. Here's another historical point. So I mentioned the context of how the early 1980s played out. Have you thought about and appreciated how big of a swing, what that precedent really means for our industry? So let's just pick on mobility, which would be tied to existing home sales. So here's the historical mobility for homeowners and renters, 1949 to the early 80s. And you can see there's the one dot in the mid 70s because the census didn't collect that data very well then. Fortunately, they did during the early 80s, once mortgage rates moderated and normalized. And you can see what happened. Deferred moves, deferred mobility, and then an explosion of future moves, which happened between 1983 to 84 to 85. Now, we're not saying this is the number that's going to play out this time, but the historical precedent on a percent change basis is really important, because what it means is we have this potential. This is the same kind of beach ball underwater analogy of deferred future moves that likely appears to be festering in some of the other data we talked about. Here's the same number for remodeling spending, excluding prices. This is real spending. So we saw a little bit of elevated activity until 1979. That's roughly when inflation outpaced home price appreciation. And then we saw some deferral. And then as soon as rates stabilized, didn't even drop that far down again, we saw this rebound in deferred remodel and home improvement spending, roughly 3 years of 25% growth year over year over year. That's the precedent. That's the precedent that we think we're tracking to. And there's factors that are affecting it now that weren't affecting it in the early 80s that could even incrementally boost it slightly more. It's hard to call the timing. Here's one. I don't think this gets talked about that often, but it's worth having at least kind of on your list of of forecasting pieces to consider. Um, so this is you probably have seen neighbors with garages like this, just full full of stuff, full of durable goods, bikes, lawnmowers, various tools. Have you thought about the shift that we saw in durable goods spending and services spending post in the past kind of 4 years, and what that means for just how much square footage we need to consume as homeowners? So here's a ratio of furniture and durable good household equipment. So this is real, so it's controlled for prices per housing unit, because you have to store it someplace. If you buy more furniture, you have to store it or throw your old furniture away. If you buy more durable goods, you have to store it or throw the other stuff away. That was growing pre-pandemic. Then here's the surge. Here's that COVID surge when people were scrambling for someplace else. It looks like we've been below that kind of trend line. And I'm not saying the trend line is necessarily the ideal line. We don't know where it should be, but we're definitely in the deferral and recovery phase, we think now. And if you think about it from a mismatch of square footage, which is another way to think about it, here is if we had just looked at levels of durable goods spending relative to the homes that you could put them in, the square footage that's available. That was kind of a series that moved along pretty similarly over time. And then, boom, here's this huge shift that happened when we saw a 22% jump between the levels, the annual volume of durable goods, which need to be stored someplace per household, versus the available square footage of homes that you could even go buy and put those units in. So we're not necessarily saying that this in isolation will be driving incremental home improvement projects, but it is striking that when we think about, like the inflation adjusted run up in home prices, we've got a 22% difference between annual volume of goods purchased per household, like per square foot. That spread jumped pretty significantly. On a real basis, home prices are roughly up about the same range, once we account for inflation. So there's a case to be made that homeowners are just consuming more housing now. You've heard this before. A lot of us are working at home, right? It takes more square footage. I heard a statistic from one of the appliance manufacturers. I was on a panel with him for investor relations for Bank of America, maybe about a week and a half ago. And really interesting statistic was, they have these smart appliances that connect, so they can see like how many cycles are they running a day and how many hours and how many minutes are they running. He said the actual workload of how much appliance volume is happening per home, I think the number was that it almost had doubled. This means people are just spending more time, using more square footage, living in their homes more. And they're doing in homes that they don't necessarily like the fit and finish and how they're set up. It's all deferred projects. And now they have more equity that's been accrued than they ever have in the history of the data. So consider this. This is the historic homeowner equity before 2020. It peaked during the pre-financial crisis boom and then declined over a period of 6 years by about $6 trillion. Here's the equity growth since 2020. So we've grown 12 trillion in accrued homeowner equity just since 2020. So that's twice the size of the drawdown that happened from the pre-financial crisis over a 6-year period, 2x that scale increase in half the number of years. To give you the 12 trillion is just an enormous number. If homeowners were to extract it and withdraw it and spend it in 1 year, which they won't, but if they were, it's roughly 40% of annual US GDP. I mean, just the scale of that number is significant. And last year, we had a pretty sizable drawdown in the overall amount of dollars that were extracted. So there's more, we call this dry powder. There's more dollars potentially at play to chase future moves, future projects, future improvements. So how will this play out for some of the individual product categories? So I don't want to go through this. There's too many numbers on a page, but just to give you a sense, we did look at this for some of the categories. Here's the amount of projects, the percentage of projects that were funded from cash out in 2021. Okay. Here's the lift that happens when you fund a project due to cash out. So the scope typically increases. You do more elaborate projects. You bite off a little bit more candy bar. You also do more positive mix shift, put a little bit nicer products. This means that roughly, let's pick on siding in 2021, about 22% of the dollars were funded due to some form of equity cash out. And that was not a year when we saw that much equity cash out actually occurring. We think right now in 2023, coming into this year, because of how far down the dollar of equity extraction, the volume of equity extraction has fallen to, that those numbers are much lower right now. So roughly call it, 5 to 7%, mid-single digits, low single digits. If we had the historic norm rate of equity extraction occur, which is roughly, call it 2% of available home equity pulled out and spent, it would imply huge increases in the overall levels of home improvement activity for a number of these categories, siding, kitchens, windows, and doors. So this is not our forecast. This is just a scenario that we're looking at, but it helps us get a good idea of the sensitivity of we've got this wave of deferred projects, people not satisfied with their home. They have more home equity than they ever have in the history of the data. And if they choose to deploy it, which it appears like we're seeing accounts beginning to get set up to access this equity, we could see a wave of spending that really is quite different than anything we've seen, at least in recent history. And the historical precedent is what that boom that we saw in the early 80s, which is pretty rapid growth. So that's a nice backdrop to have it. And just to give a sense of really what we're comping, this is a nice way to think about the pro labor backdrop. Matt's going to talk about pro labor in just a minute. Maybe you heard some of these, Home Depot has begun talking more about the complex pro, which basically means the pros that are touching a variety of types of projects, maybe building homes, involves much more coordination, similar to home builders, but maybe for home improvement. Have you thought about how that growth of this deferred projects is going to impact that group? So here's one way of thinking about it. Let's just pick on insulation. Just insulation, because it's a pretty simple, unfancy product. But this could apply to any of other categories. I'm not accounting for people that are tearing out and just doing insulation jobs. But let's say like these are big structural changes to the home. Here's structural addition to the home where you'd have to put in something like insulation, whether you wanted to or not. It's declined pretty significant. And by the way, we've seen similar paths for categories that are exterior. We saw the same thing for windows and doors. Same thing for siding, kind of this general deferral post 2015 in volume of projects. Here's where 2000 levels were for the stacked combination of housing starts and structural additions. Here's where we are right now. If we go where we think we're going, there's enough deferral that we could get to what would have been like historically fairly normal rates, but we don't have anywhere near the labor to deal with this type of potential backlog. So it'll be interesting to see how these things develop. We think the precedent is pretty striking. Again, just to touch on this point, both these headlines happened in the past 3 months. The largest equity raise, focused very much upstream, likely to touch pro labor at some point, as well as this big investment focused on the complex pro, which means the industry is shifting pretty rapidly. And where we'll see the industry grow 3 years, 4 years, 5 years from now, likely will look quite different than what we saw, this year or 2 years ago, or anything over the prior cycle. So, with that being said, let me turn it over to Matt to give an update on some of the details that we're seeing from that complex pro.
Thank you, Todd. So yeah, we're going to talk through some different labor issues contractors are facing, go through some key metrics, and then importantly, talk about how that is having an impact on their purchases of different brands across the industry. So each month we track project pipeline levels with our pro subscribers. And here we're viewing contractors' year-on-year changes across a few key project types. Overall, project pipeline growth peaked last summer and then hit a trough in the winter. Over the past few months, they've actually been doing two things. They've been rising, but then they've also been centering around a pretty tight and similar range. So overall, exterior improvements are doing best. Unfortunately, best is just flat year on year when it comes to project pipelines. And kitchens and baths are actually down almost 1%. So unfortunately, there's just fewer incoming projects overall right now to go around. Now let's look at pipelines by contractor revenue scale. There's definitely more variance from this vantage point. And although they're rising since winter, all are flat to down year on year, except the largest contractors, those with $2.5 million or more in revenues. And this represents a reversal since last fall, importantly, when the smallest contractors with this green line actually had relative strength. We're seeing that go away.
Okay, let me just ask you
However,
a question
yeah,
on
go
this.
ahead, Todd.
This is
Sure.
a good, a good data because if if we think about pipelines, almost like inventory to sales ratios,
Hmm.
flat, the industry could grow or it could shrink, but changes in pipeline really is a nice read for changes in pricing power and turning points in that, right? Because
Exactly.
yeah, okay, this is why the complex pro matters so much because that's the only group that's seeing pricing power begin to move.
Yeah, and you're going to see how that plays out in a moment because if you have no pipeline and minimal backlog, you have crews waiting to do work, you're going to price your jobs differently, right? You're just going to grab jobs, maybe jobs you don't want, maybe at prices you don't want, and that can really have both a short-term and long-term effects. So here we're seeing, unlike the settling among the projects, the volatility we're seeing month to month is really not settling at this point, and it's frankly unclear where this is going to go the next few months, kind of by size. Now, backlogs, of course, are the partner metric to pipelines, right? And most contractors are unfortunately experiencing shrinking backlogs, and to a large extent the biggest contractors' backlogs in this blue dot on the bottom are actually down 32% index against last April. And so the increasing pipelines that they were just looking at for this group are really a welcome relief because the well was getting dry. So it's fortunate they have a lot of business coming in right now. Obviously, a very positive sign for the future for larger contractors, those complex pros Todd talked about. But almost all contractors are working through their backlogs right now on top of having weakened pipelines. And as we were starting to say a minute ago, this is dangerous on a number of fronts. Beyond the obvious revenue blips, it also forces them to be aggressive on pricing, as Todd was saying, potentially cutting into their profits. But it also, does some more insidious things. It makes it harder for them to hold on to labor between jobs, makes it harder for them to be the GC of choice for skilled trades. And these can really cause lasting issues beyond their month-to-month revenues. And so obviously these dynamic backlog and pipeline situations are going to affect contractors differently and adversely. So here we're looking at the net profitability impact on jobs that the pricing changes and the costing changes are causing. And by cost, we're looking at both what they are spending on materials and labor. So, as Todd was saying, along with their pipelines, larger contractor job profits are starting to grow. And you can see, they were again, the worst in February. Now they're up 1% year on year. Did you want to add something there, Todd?
No, all I was thinking here, I mean, this is one of those charts that the important story here is the scale, right? So we saw this if we think about a year ago, discussions around, you had this underlying backdrop where almost all the big pro contractors, regardless of scale, had to go to the big box retailers in 2021 and 2022 just because that was the only group that had enough procurement and could actually have products in stock. And then we saw kind of that begin to unwind, but it was a preference issue. Now what we're seeing, if we read it right, is that it's really an end market issue where you have a certain pocket of homeowner, that middle income group that maybe is doing some DIY, or if they are hiring a pro, they're hiring the lowest cost, most willing to flex on their cost type pro contractor, which tends to have quality issues. That's what we're seeing dry up right now. That sub 250K, but up two or three rungs on the price point, these deferred projects, that's where we're beginning to see growth. So it's hard to call the quarter, but this is kind of exactly what we would expect to see play out, giving that divergence between some of the groups.
Thanks, Todd. And I'm actually going to ask you to comment as well on if you think we are seeing that unwind that we predicted back in January, meaning look at the beginning of this chart where the smallest contractors had job profits up, 150 basis points year on year. Now they're down 30 basis points year on year, and they flipped position. I know earlier in the year we talked about small maintenance, maybe roofing repair jobs after the winter. Those were the types of things keeping these pros busy, but those jobs tend to be short, tend to not be huge revenue jobs. And we talked about an unwind coming. Do you think that's happening now, look here, or do you think we're still a little premature for that?
Well, I think it seems like we're definitely seeing, it's the divergence that's important. It's the
Yeah.
divergence that's notable here. So I think, another way of thinking about, that 1% jump that's happening for the 2.5 million is that there's a design build story here of major projects. We've touched some of these on custom work where we would see $350,000 worth of windows and doors, being shipped to a home that was only worth $300,000. It doesn't make sense. Why would that ever
Hmm.
happen? Turned out it was attached to, a much broader, almost an entire rebuild of adding rooms and features, and that's not going to happen for the smaller contractors. So I think what we're seeing is just a continued unwind that's focused on that kind of price point that of the homeowner that we're talking about.
Right. Okay, thank you. So we thought it would be useful to dig into the components that are driving these job profits so differently by cohort. And interestingly, smaller contractors have actually been able to hold price year on year better than their larger counterparts. So here you're seeing job prices were up 8.7 for the small and medium contractors and only 8.4 over larger. So small contractors actually had a bit of an advantage here. Unfortunately, though, when it comes to the cost side, the larger contractors have a major advantage. And this comes from not only buying scale, but also buying sophistication, and that they've been able to hold their cost increases to 7.5% versus 8.8 for the small. So really it's a story of cost control is what's driven their job profits so much higher than price versus their smaller counterparts. And we just wanted to share that. And Todd talked about labor earlier. Each month we track contractor concern levels. We collect it on a large list of items. These are just the top five. But the left axis refers to the gray bars, which are the kind of these top five concern levels, inflation, labor costs, etc. And you'll see that two of them are economy driven, inflation and recession, and then two are labor driven. And a few things kind of pop out to us here. Labor costs. So if you look at these trend lines, this is the change year on year in the concern level. We've been tracking these monthly for a while now. So from spring 23 to spring 24, contractors of all sizes have been either at best flat, but mostly more concerned about labor cost. It actually trumps labor availability. They're generally finding labor, but they're finding it at a much higher price. And then at the same time, supply chain concerns are down across all groups. We think they're down too much from what we are seeing out there.
That's
And frankly, we believe part of it is that volumes are down and it's making it a little easier on distribution. Go ahead, Todd.
Yeah, that's complacency right there, for sure. I think
Yes.
it's so easy for have we forgotten what happened, in 2021 was not that long ago, where we saw situations where you basically had to pay for your spot in line, or you had to really be willing to sacrifice either what you wanted or the quality of who you would get to install it. And so we keep hearing this drumbeat of, supply chains are fixed. We would love that to be true, but what we're not at all necessarily convinced of is, at least from the labor side, um, a lot of these product categories have significant upstream labor exposure. Apart from some of the other, kind of more more like component driven and or input driven issues that could actually have an issue. If we were to see a scenario like that played like the early 80s, if any of these backdrops that were kind of trying to look ahead were to play out, there's a number of categories that we don't think are that well positioned. Say even like forms of hardware, other inputs to windows and doors, even some of the issues that we're seeing, within siding. Goodness, you can't even get certain colored products right now at all. Period. Um, so I guess our concern here is it's complacency because the market is soft. If the market were to normalize, these will flip flop pretty quickly, and then whoever can deliver the pro labor and deliver the product will have a significantly different basket of pricing power than than the rest of the group.
Yeah, exactly. I mean, looking at the forecast we have for the next couple of years, it's going to put a lot more strain on supply, on lead times, et cetera, and obviously on labor, as we're talking about here. The other thing interesting about this chart is if you look at the purple line on the top, which are the smallest contractors, their concerns are highest at virtually every level. Only supply chain have they not increased more than one group. But otherwise, their concerns are rising well above the others. And when you think about all the metrics we just looked at, these folks are unfortunately really taking it on the chin right now. So let's switch gears and talk about how contractors are spending money and dealing with these pressures. Last year, to coincide with the publishing of, oh, actually, Todd, do you want to jump in
Yeah,
here?
just a bit of context. So, one of the pieces that we had sent out, this was goodness, this was right before the big box retailers reported. And the only reason we reference them so much is because obviously they're just so important. Like they move so much of the industry. Is we have all of these pro contractors that work with Zonda because of the trade publications, and so we'll continue to learn from them to ask about their conditions of their business and where they're going. And one of the shifts we saw was that a large portion of these pro contractors, as they began to change where they purchased, some of them were purchasing in kind of traditional distribution, but then there was also a group of pro contractors that were purchasing at what we would call pure online. So that basically is online presence, but without a brick and mortar location. So think Amazon, maybe Build.com. We know that's owned by Ferguson, but in terms of the experience of a pro that's shopping, it's a very different purpose. And so the reason that what we have this here is that we basically had three hypotheses about so what's going to happen. What happens when you go from having say 20 or 25 products that you can choose today, or maybe you have to special order some, to thousands of potential products that you can buy at an online location as a pro. Like, what do pros do? How are they using it? And what we thought was, look, there's basically three options. Option one is just an outright race to the bottom. We want to get the cheapest price we possibly can, and obviously you can do that online. Option two would to basically use those online tools as a way to purchase premium product. So I'm going to buy, better products than I normally would have, but I don't have to special order it. Maybe there's a logistics play here. Amazon's just better at getting things to my front door, dropped off on site wherever I want it, and they do it at a low cost, and it's pretty dependable, and I can see when it'll be there versus some of the alternatives. Or the other alternative was basically to kind of shop those channels, price check, quality check, read reviews, but really, end up purchasing at traditional channels. And so what we found was we put this out, boy, I think a month ago, where when we looked between the individual product categories, we saw really different behaviors about what exactly happened in the basket when these pro contractors went to, these complex pros went to pure online locations. And what's interesting here is it's some of the same outperforming categories that we had identified through the other research. I'll pick on siding, cladding, decking and railing. Appliances is having some other issues, but there's a cluster at the top, which basically meant that these pro contractors, these complex pros, when they purchased online, pure online, upsold themselves, bought nicer stuff, and maybe they got a great deal, but that was a special order that didn't go to another location. And there's a number of other categories that really didn't make much of a difference, but there's definitely a division happening. So kind of the working hypothesis we have is when you have a much larger universe of potential places to buy and brands to buy, that it impacts how important it is that your pro contractor brand awareness of your product. We could see more concentration of profits among a few really high performing brands within, say, cladding or within, say, decking and railing, as that happens. So go ahead, Matt. I know you have some data on how we think about that.
Yeah, thank you, Todd. And we'll wrap up these next few pages pretty quickly here. And so last year, to coincide with the publishing of Zonda's annual brand usage study, we introduced the brand stickiness measure, something we came up with that basically plots a brand's awareness against the pro's commitment to that brand. So of course you want to be in the upper right quadrant, right? Representing both high awareness and high resilience. And with the new round of the brand usage study, which is going to be coming out later this summer, we're going to have the ability to see how the brands have fared and shifted amongst pros over time. We are capturing actually a lot of new information in this year's study that we're going to make available to our subscribers, and including this. And we're just digging into results now, and we'll share a few kind of back of the envelope category analyses here. And then later this summer, when the study is published on our Zonda's media websites, we're also going to offer some custom premium reports that go a lot deeper at the category and brand level. So if that's something you have an interest in, they're going to be kind of created custom. So just email us and we can kind of put you in the waiting list from when those are available. So we want to look at a few categories. First, we're going to dig into decking and how it's changed over the years. And for all of these next few charts, we're looking at just a few brands with top contractor awareness. So let's look at composite decking first. So the big story here is the long red arrow going from TimberTech. And while their brand awareness has remained strong, the contractor's commitment to them has dropped pretty significantly. So what that means is the contractors were willing to substitute other decking brands at a pretty active level. At the same time, Trex and Fiberon might have been the recipient of some of this trading away from TimberTech as their brand stickiness grew. Green arrows because they're getting closer to that upper right quadrant that everyone wants to get to. So they had out what we would call moderate changes for the positive, versus TimberTech having a pretty rough one down to the left where you just don't want to be.
And another way of thinking about this, Matt, would I be right? The reason
Mm-hmm.
that stickiness matters so much is if the pro is changing where they buy, we care very much if they're going to seek out these brands. Like if you're Trex, you care very much if you're on the list of whether or not they're going to come find you, or if they're going to be, willing to swap you out for just maybe say a, similar but lower cost alternative or whatever's convenient.
Yeah, and honestly, we're only showing the highest awareness brands here. There are, of course, a lot more composite decking brands. And as you said, Todd, they're not all available everywhere. So as a pro switches channels, suddenly different brands are going to be on the shelf and available to purchase. And so, with brands not all having full distribution, they can easily get lost in the shuffle when the pro changes. Then the other thing happening, as you saw, is, costs are up in the aggregate 7, 8% or more. Pros are looking to save money where they can. Um, Decking isn't a place that a lot of them can, unfortunately, because there's a very high level of specking done, and there's also a lot of homeowner awareness of decking brands. I would say that's different than insulation, which is just not as, homeowner forward a category. Insulation didn't fare well as a group, and these don't have to, the way this math works, they don't have to net to zero. And so in this case, all brands are down because contractors readily made trade-offs on insulation brands. It's not the kind of thing that they're necessarily, selling to their homeowners or even commercial buyers, and it's endemic of the cost and other pressures that they're facing right now. I mean, times like this are just a real proving ground for brands. So unfortunately, Owens Corning especially dropped substantially, in that a lot of people traded off this high performing brand just like they did TimberTech. So it showed some real weakness and commitment in the end that existed last week when times got tougher. And lastly, we'll just touch upon interior lighting. If you've heard us talk about or read our coverage on this in the past, we have found lighting to be a very fungible category in that most brands people will readily trade off of. They don't know the brand necessarily, that the homeowner level that they're purchasing. And again, all three top, and these are the top awareness brands, receded to this lower left quadrant where you don't want to be. And Juno, just to pick on that for a moment, even with a decent 35% brand awareness, um, no one cited them as their usual brand. So it just showed that a well-known brand can be traded very readily if it's going to save a project. And so there's a different story for every category. And then obviously when you go into the category more beyond the top brands, it gets a lot deeper. It's very important because, as your category is more fungible or your brand itself doesn't have the stickiness, you're sliding to this lower left, and at the same time you're doing line reviews, which can be very challenging, and you're proving why you still remain on the shelf. So it's a very important thing to kind of understand about the brands you're inspecting, whether they're your company or a company you are investing in potentially. So again, if you want to dive deeply into a brand or a category's performance, shoot us an email, get on our list for when our study and customer reports come out late this winter. And that's all I have, Todd. Thank you.
Yeah, there will be an opportunity at the survey at the end. I'll give the summary here, but just so it's on your radar, if you want to get a hold of that brand detail, you can check one of the boxes, or you can send us a note, find a way. But there's so much detail coming out there. It's going to be something that you're going to want to have on your radar, because we're going to see a big spread, we think, develop between not just the market share and revenue, but also the profitability. A number of these companies is shifting. So summary, like we said before, we think the risks to building products are really culminating in the first half of this year. It's horribly difficult to track the quarter, but from what we can see, we worked through most of the pull forward that's happened among that middle income group. We see more risk in the mid-range, call it sub $25,000 remodels. That's negative the whole year this year before turning next year positive. Beyond that, though, we have a really interesting story that's developing, deferral, which is increasingly looking like what we saw during the early 1980s. But some differences: far higher home equity, more of a matching issue like we talked about, case to be made of more consumed housing, including square footage. We think this increases the long-term equilibrium 2025 to 2030. We've talked about the golden age of remodeling before, holding a beach ball underwater, whatever that might be. The level has to go up, and that's the important takeaway. And it's happening at the same time as there's more challenges around labor and procurement than there was before. So our message is this: change is underway. Change is underway in distribution. If you don't have that message, it should be loud and clear. There's also a case to be made that you'll see greater concentration of industry profits within a few outstanding brands, and then kind of a sea of mediocrity. So brand strength, pro contractor perceptions, execution, all of that is going to drive pretty significant differences. There are some companies that are doing a great job right now, but it's obviously pretty varied across the board. So please take the survey at the end, reach out to us if you have any other questions. But thank you for attending. And if there's any questions or any follow-up, we'll follow up by means of email. But thank you for attending, and please take the survey.